If we look a year ahead, the property fundamentals across the business, both in South Africa, Australia and the waterfront, are very, very solid. Vacancies are low and near all-time record lows. The waterfront vacancies are as low as they've ever been. In Australia, vacancies are 0.4% of lettable area. So the underlying fundamentals are pretty solid, and we don't see that changing too dramatically over the next 12 months. What's of major concern, or of bigger concern to us, is the macroeconomic indicators, and again more specific to South Africa, certainly less so in Australia. But South Africa's got a number of challenges with very low GDP growth forecast, major labour unrest, a number of strikes. We've potentially got a looming debt downgrade on the sovereign debt. All of these factors, we believe, are negative towards long bond yields and long bond rates, which impact the share price of listed property shares and Growthpoint's share in that regard. So, that part of it is probably a little bit concerning. Retail, we continue to look for retail growth, net property income growth of 7.5%. Vacancy sitting at 3%. We don't see that moving much higher. Office sector sitting at office vacancies at the moment of 8.7%. That was impacted by some new developments that we brought online this year, but we do see that coming down. 8.7% we think would come down probably closer to hopefully below 6%. But it's going to be pretty competitive because the office sector is a little bit oversupplied at the moment, and the dynamics there are a little bit weak, especially as the demand side is not being fueled by any meaningful GDP or economic growth or activity. Industrial, on the other hand, very stable, low vacancies. In fact, low vacancies nationally and not just in our own portfolio. So the supply-demand dynamics in the industrial sector we're very comfortable with, and believe that industrial will again produce a good result with bottom line net property income growth of between 7 and 8%. Australia, the opportunities there are still pretty healthy. Looking at acquisition opportunities and investment opportunities with yields of between 7 and 8%. Very attractive when your funding cost in Australia is probably in the mid-5s, 5 to 5.5%. And in waterfront, a lot of activity on the go there. We've got 14 different projects, development and redevelopment type projects on the go there at the moment. A lot of money being spent there and invested there between ourselves and our partners, the PIC. We're spending over R1 billion there on new projects, all of which we hope to deliver results in the next couple of years. I think the one thing with the waterfront is your time horizon for the investments to start delivering is probably a little bit longer than you might find in the balance of our business.